Welcome to Market Masterclass, and we're delighted to be invited to the first Metro Securities Bank building here in Makati City,
Yeah.
the capital city of the Philippines, and we're very pleased to meet Alexander Gilles, who's with the group since 2009. If you could explain your background to investing.
Yes.
And how you got to be where you are now.
My background in investing was I started out as an equities analyst, which means I would write articles about which stocks are good to buy, what's the latest story on these listed companies. And I was writing for James Capel Securities, which became HSBC Securities later on. And then I moved to another brokerage house, but then I was hit by the 1997 Asian financial crisis, and many people stopped operations. But then little by little that all resumed in 2001, and then the stock market started moving up again. I then became a professor at an MBA school at LaSalle University, and I was teaching finance and investments. Around about 2009, I joined First Metro Securities because they needed an in-house teacher for clients who were trying to learn how to invest in stocks for the first time. What is a stock? What is a preferred stock? What is a common share? Should I get into stocks at my age, and what are the advantages and disadvantages? So I made it my job to explain to beginners how to get started investing in stocks, given that these are risky assets and many people are unfamiliar with them. But they're curious and eager because savings deposit rates have come down to 0.5%, and people who used to get 3 or 5% on their savings are now receiving 0.5%. which is not as bad as other countries which pay -1%, but still 0.5 is below inflation. It's below inflation of 2.
Sandy, you mentioned 1997 sort of crisis, and then there was the 2009 one that you all know about. Does that make it very more prevalent that's just after those sort of crises, people need to be told again how to go about investing? Does it make it, you have to do a sort of additional lesson for people because they suddenly become more panicked?
Exactly, yes. After the 1997 crisis and the 2009, 2008 global financial crisis, the Philippine markets dipped, but more because the foreign investors who had bought Philippine shares needed money. So they had to pay off their debts or their loans back in Europe or the US, and they needed cash. So they had to sell their Philippine shares, even though there was nothing really wrong with the Philippine shares except that the investors needed money. So to raise money, they sold their shares, and the shares were sold down. And then they came back up. A year or two later, they were back where they started, and then they continued moving up again. So it turns out that looking at the chart, the best time to buy was at the dip. The first dip, and then the second dip, and then we're back to where we started, and then we're continuing at an even pace, even proceeding higher than before. Sometimes the market does exceed, moving too fast for its own good, then it returns to its normal path and then continues on at an even pace. It's been moving up, I would estimate, since 1987 to the present, 9% a year, per year for the last 28 years.
So people always talk about bull markets and bear markets.
Yeah.
What you're saying, I think, is that over the longer term, it always turns out to be a bear in the longer term, but there's always these dips.
Yes, yes. It turns out to yield a positive number over the long term. I noticed since 1987, we've had a very rocky political history, but the economy has been slowly growing since then, so that we are now at a very good economic growth rate, and the corporations in the stock market are making money, and therefore the shares of stock are well supported by buyers who like the cash dividends that they are receiving. So those shares of stock are well supported, meaning anybody wants to sell those shares, somebody comes in, steps in, and buys it up, and so it remains where it is. Every day there's news that, oh, there's foreign investors selling now for the 18th straight day. Not to worry, because there's another interested local investor, or perhaps another newbie foreign investor who wants to come in and sample and get his first taste of Philippine shares. It's a very resilient market as a result.
And how many shares are there available in the Philippine market?
There's about 290, $280 billion worth of shares of stock that anyone can buy. Uh, it's open to people from any nation. Just register with a stockbroker and say you have a taxpayer ID number and therefore you want to be able to buy Philippine shares. It's the exchange which regulates how much you can buy. Normally it's 40% maximum of certain utility stocks. Other than that, you could simply buy as much as you can on the market, and it's internally regulated how much is available for sale to locals and foreigners. So just go ahead and place orders with your broker and wait for time to pass. And if it's a good stock, fundamentally good, you would tend to be rewarded over time.
And they have obviously a Philippine Index.
Yes.
How many stocks are in that sort of index? And that, I guess, basically is a sort of wrap-up of the overall economy, is it, the index? How does that work?
The index is a wrap-up of the overall stock market because there are 270 shares of stock or companies listed, but only about 30 are really moving on a day-to-day basis. And on the top 30, you have about 80 or 85% of all the trades. So it's worthwhile to just look at the top 30 because the others are inactive or they move once a week, or there's very little interest. So might as well focus on the big ships or the big blue chips in the top 30, and they account for 85 or 80% of the activity on any certain day. So if you're asking what happened to the stock market today, a standard answer is usually, well, the top 30 moved up 1 or 2%, and that seems to account for 85% of all the activity for the day.
Okay, and these stocks are available on a daily trading basis. There's no period when you can't buy. They're just open Monday to Friday. Is that the way it works?
Yes, they're open Monday. The stock exchange is open Monday to Friday. Anybody who wishes to buy and actually execute his order will have to trade between 9:30 in the morning till about 3:30 in the afternoon, except that the computer of the stock exchange is closed during lunch break at 12 to 1:30. The computer is closed, so no orders can be accepted by the system. So therefore, you can only execute an order from 9:30 to 12 and 1:30 to 3:30. However, if you're interested in buying a stock and you don't mind waiting, then you just place an order through online brokers, which means that the order will be pending even after hours, even at night. You can place an order, and then the computer will tell you, sir, I'll take care of this in the morning, 9:30 the next morning. I just go to sleep and I'll just attend to this at 9:30 the following day. It's now possible. So now you can place an order on an online broker system, even after hours, even at night, even on weekends, even on holidays. The computer will say, I got this, I'll take care of this on Monday morning at 9:30.
So obviously there comes a time in a person's life when they want to know how and where, what to do and how to get into stock. So you have been for many years now traveling around the country, I believe, training people and teaching people and giving them, sort of opening the gate for them to move into these sort of markets.
Yeah.
So you're a trainer.
That's what I'm doing, yes. I'm a trainer, and I educate people in the pros and cons, the advantages and disadvantages. This is the way to earn money in stocks. It's not easy, it's quite difficult, and it's a risky asset. So there needs to be some training and preparation. You need to know what you're getting into. It's a very volatile market, so therefore it's not safe to be investing short term. It's far safer to be investing long term. And it's also good to do research before you buy only stocks with good fundamentals. Therefore, it gives you a greater probability that the stock that you're buying will be moving up over time. What I say to beginners is that you probably should be saving money for the long term, for your retirement. If I speak to a 30-year-old person, he's 30 years old, he's thinking, I retire at the age of 60, then I advise him to put aside money every year, say 30, 45,000 pesos per year, and then let that reside in good stocks and keep it there for many, many years. You can get so much benefit after 10 years, after 20 years, after 30 years. And people say, I can't think 30 years, that's too long for me. But I say, but you're eventually going to retire. So therefore, you need to have money waiting for you by the time you're 60, 65, 70, 75. So I suggest that you start saving now. Let money grow 7 to 15% a year. If you're lucky, close to 15. If you're not so lucky, between 5 and 7%. But can stocks really do that? Yeah, they've been doing that since 1987, 9% a year to the present. What about since 2002? Even better, 14% a year from 2002 all the way to 2016. What about since 2009? Even better, 33% a year from 2009, from the depths of the crisis to present day. So I think it's either you're going to make 9 or 15%. Let's not talk about the 33. It's too amazing to believe. Let's just focus on the 9%. That's your humble target and ambition, and save some money, park it there for many, many years, so that when you turn 60, you have retirement money.
So I think, am I right in thinking that it's fair to say that the younger you start putting money aside for retirement, the less you have to invest?
Yes, you do.
The earlier the better?
Exactly right, yeah. Because if you start investing at the age of 50, for example, let's say put aside 100,000 pesos. Then after 10 years, by the age of 60, it'll be 404,000, which is okay. But it's nicer if you started when you were 40 years old. 100,000 pesos growing at 15% a year for 20 years becomes 1.6 million, which is probably going to be the cost of living by the time you're 60. Now, if you started at the age of 30, 100,000 pesos invested at 15% for 30 years becomes 6.6 million pesos. That's the reward for patience, for bravery and patience. You have to be brave enough to get into stocks, and you have to be patient enough to wait, and also brave enough not to get out even when you're scared, because there's ups and downs, and there's good news and there's bad news. So just brave it out, tough it out, and then you'll get your reward over time.
Okay, we spoke a lot about retirement there. What are other areas that people make plans for in the sort of nearer time future?
Yes.
What do they? I mean, if they're going to, obviously, if you're going to buy a house in a couple of years, it's money from the bank.
Yes.
Don't touch any of that. But school fees planning, is that an area that people look at as well for putting money aside?
Yes, of course. Planning for tuition, planning for school fees, that needs to be planned. So when a concerned parent plans his savings for the next 10 or 15 years, he wants to think about the car he wants to buy, the house that he wants to pay for, and the tuition fees that he needs to pay for the next 18 years. So that's about 18 years of savings that you need to look out for. And I would suggest that the money would be safer in bonds, in government bonds or corporate bonds, perhaps in preferred shares. Then you have a regular cash flow that you can rely on, and you can hope to receive between 3 and 6% a year for 18 years. Because this is money that you cannot gamble with. It needs to be available when tuition needs to be paid. Now, what about so-called emergency money? Every household has to have emergency money, which is money that you should have, that you don't spend, but you keep it for medical or fire emergencies. Well, it's money that should be equivalent to 1 year's salary, I would say. And then you park it either in cash or bonds or in shares of stock, depending on how confident you are about the stock market. Now, there's something else called investing for retirement. That's where I go to town and explain that you really should think 30 years ahead, because you are the ultimate beneficiary. So you'll be saving money for your benefit. And then there's one last thing that people want to save up for. When they're turning 50 and 60 and they're grandparents, they start thinking, what can I do for the benefit of my family for the next generations? And which is a very noble concern, which leads people to say, I'm going to put aside a sum of money, I'm going to invest it to grow. I could put it in savings account, sure, but it would grow only 0.5% a year. I could put it in bonds growing at 3%. Why not put it in shares of stock that grow very erratically? However, they do manage over time to turn in a respectable 14 to 17% a year, over years, over 14, 17 years. So it's a matter of being patient and being brave and waiting for time to pass, because the economy grows. And then the listed companies make money, they make profits, and they share these profits with the shareholders. And you, as a shareholder, will receive these cash dividends over time. Plus, you will get the benefit of the share price moving up slowly over time. So this is ideal for somebody who's saying, I'm a grandfather now, I want to do something for the benefit of my family for the next generations. I will put aside a sum of money that I will put in shares of stock, and this will be for the benefit of my grandchildren 30 years from now. So that one day when my grandchild says, Lolo or Grandpa, I want to study in this elite university, can you take care of the tuition for me? And Grandpa can say, I'll take care of it for you. I've set aside a fund just for that, scholarship for the family members who qualify for a college or want to put up a small business, for example.
And I see from reports in the newspaper and everything that as far as Asia goes, the Philippine economy overall has been a top performer amongst all the countries in Southeast Asia, and that seems to still be continuing.
The Philippines is a good performer economically speaking, since our economy is growing 7% and other Asian economies are growing 3, 5. Our stock market is okay as far as other Asian countries are concerned. By comparison with other Asian countries, our stock market is valued at a high premium. The measure here is the price-earnings ratio. And our price-earnings ratio is running at 18, 19, 20. Other nations are at 11, 12, 13. Of course, Japan is at 20 also, but that's a rich country with a very reliable industrial base. And here we are, a small country, deserving also a high price-earnings ratio, which seems to imply that the Philippine stock market, even though it's expensive already, still attracts investors. And we're wondering why. And it probably means that they're confident about the future of the economy and are not scared of any political firecrackers going on around us. And they think that my money is well invested in the Philippines because it will come up with positive surprises in the future. Despite all the negative news that you hear at the present, there might be positive surprises in the future, like gross domestic product growth possibly more than 7%. That might be coming up over the next 10 years. And that's an array of good news, considering that other Asian nations are growing at 3, 5, 7, less than 7. And then I think the US is growing at 1% a year, and Europe growing also 1%, and Japan growing at 0. So therefore, if Southeast Asia is growing at 6% and the Philippines within that subset is growing at 7, many investors are thinking, I think I should invest some money there in the Philippines. So, and there's a constant supply of new investors. So even if somebody pulls out because he's nervous, here comes a new guy wanting to invest in emerging markets, especially Philippines.
And as a successful and growing economy, the Philippines, are they dependent on other economies in the region for part of that success, or is it sort of linked in with other economies, or are they sort of fairly independent as a growing economy?
So your question is whether we're linked to the economies of the neighboring countries. I think our exports are principally with the big industrial nations, Japan, China, US, Europe, and then not so much, and a little bit with Southeast Asia, I would imagine, but trade is a big part of the economy, but it's not the biggest part. The biggest is the domestic consumer spending. And that seems to be the saving grace of the economy now that we don't have much exports to speak of. It's still negative compared to imports. So it's actually now consumer spending driving the economy forward, plus the private sector investments.
And am I correct in saying there's a sort of quite a rapidly rising middle class, so the consumer spending is looking up into the future?
I hope it's rapidly rising. What I can see is that we have 1% of the population earning about 200,000 pesos per month, approximately. Then you have 10% of the population, 10% of the population earning about 50,000 pesos per month. That's in terms of national income accounts. Then you have like 35% earning like 20,000 only, and then the rest of them earning 5,000 pesos per month. What's middle class? Middle class would be the one earning 50,000 or more. So it's 1% who are well-to-do, 10% earning the 50,000 or more. That's the middle class. I'm hoping that those below, in the bracket below, are those earning 20,000 per month. And I'm hoping that they graduate to the 50. And that can happen if they attain managerial positions within call centers, or if they become well-paid architects, engineers, lawyers, doctors, working whether in the Philippines or anywhere else in the world.
And that group, the sort of 20,000 group, are they the ones who are particularly keen on getting your training and learning about what the potential is in the stock market?
Yes. I conduct seminars Mondays, Wednesdays, Saturdays in Makati, in Binondo, sometimes in other cities. And for most of the clients just walk in because they see the advertisement on our website saying that there's a class on Monday at 10 o'clock and there's another one at 5 p.m. Plus there's another one on Wednesday at 2. So they walk in and then I say, hi, hello, would you like me to explain how stock markets work? Yes, because we've never bought a stock before. We've never bought a single investment fund before. So we'd like to know how that works. So I give them the ABCs and I tell them that you probably want to avoid rapid fire trading because that's only for experts. You probably want to buy regularly every month or every year. You probably also might have a big savings amount in cash. You probably want to transfer that to stocks over the next few months in staggered fashion. And then I advise you to wait. And then they say, really? Is it safe? It is relatively safe. I mean, it's not completely safe because there's an element of risk. But if you put it in good stocks, and they ask me, what do you mean by good stocks? Those with good companies with good profits and stocks with stable growth in their earnings. Meaning the company makes money year after year, slowly but surely, and in some cases, fast but surely. So the task remains to look at examples of companies who have good earnings, whether it's stable or growing, not the ones with earnings which are plunging. And I can give you many examples of bad examples. So therefore, I tell them that there are some good examples and some bad examples. Businesses which are doing well and those which are doing badly. So obviously avoid the ones which are doing badly. I wouldn't recommend a stock like Eastman Kodak because their Kodak film is out of fashion, right? So I would recommend stocks which are related to basic human needs like food, clothing, shelter, energy, transport, telecom, banking, and mining. So I would say your portfolio should have those 8 types of stocks. It's up to you to choose. I give you 3 choices of this, 3 choices of that, 3 choices of this.
So that helps you spread your risk.
Yes.
So you mentioned earlier, you talked directly about stock investment. You did mention funds. What funds and what's the advantage or disadvantage of going into the markets through funds?
Right. There are first-time investors in risky assets and are wondering, should I be in stocks or in the so-called investment funds? And I ask them, would you like to drive a car yourself or would you like to hire a driver? If you hire a driver, you have less stress and less burden on you, but you have to pay him a salary. On the other hand, you have less control. If you hire a driver, he drives the car and you're not at the wheel. If you want more control, I guess you have to drive the car yourself. And you save some money by not having to pay a driver. So that's the first question. If they say, I think I'd like to drive the car myself, then I tell them, okay, then you have to learn how to go from first gear to second gear, third gear to fourth gear. Oh, that means I have to study about stocks. Yes, you'll have to learn what is a common share, what is a preferred share. You'll have to study what is earnings per share and the price earnings ratio. Oh, is that really necessary? Yes, it's like learning how to put your transmission from park to drive or park to reverse. That's very important to go in the right direction. Okay, I'll study that. Now, what if I really don't like to drive the car myself? I want to hire a driver. Then you have a choice. You can either go to mutual funds, unit investment trust funds, insurance VUL, or an exchange traded fund. So one by one. You have mutual funds. A mutual fund is an expert who works for a stockbroker company or is related to a stockbroker company, and he knows how to manage the client's funds. Clients put their money in the mutual fund and it's managed in an even way. And then if you want to pull your money out, you just exit your shares. Now, if the expert in the investment fund works for a bank, then that's called a unit investment trust fund. It's simply an expert within the bank who knows how to invest money, and he will take your money, invest it for you. If you want it back, he'll give it back to you. Now, there's a third invention called the exchange traded fund, which is an investment fund. Okay, it's set up like an investment fund, and normally you would have to go to the office of the investment fund to buy it. But this time, the investment fund is listed on the stock exchange, so that if you want to buy the shares, you just go ahead and buy it as if it were a share of stock. And that makes it considerably cheaper than the mutual fund, because the mutual fund and the UITF, they charge about 2% a year for the salary of the driver, so to speak. Meanwhile, the exchange traded fund is an investment fund, but it's managed by a computer, semi-automatic, and so therefore it charges a smaller annual fee. It's way cheaper. So it's like the modern, lower cost version of investment fund. And the fourth or third thing I mentioned was insurance unit-linked funds. And that would be an insurance company offering an investment fund, because they do have experts within their roster and they do know investing. So there are many insurance companies who say, just give your money to us and we'll take care of it the same way we took care of your insurance policy. That's also a valid approach. If you have a lot of dealings with the insurance company, go ahead and invest your money with them. If you trust your banker more, go ahead, put money with your banker. He's going to put it in a UITF, and if you need your money back, he gives it back to you. If you are impressed with your broker, talk to the mutual fund. Usually the broker is running a mutual fund. Put your money there, he invests it together with the money of a million others, and when you need the cash, just pull it out. Just give him 3 days notice.
When we were talking earlier, I thought you did a very good description of, like you were doing there about a motor car. Everybody understands driving.
Yes.
And you were talking about swimming.
Yes.
If you learn to swim, yes, if you don't learn to swim, you could drown. But if you learn properly, you'd be safe to swim. So stock market investing is very much like that. It's just learning the ropes.
Yes.
So that you'll be confident and it'll work for you.
Learning the ropes is for sailors, isn't it?
That's true, yeah.
So when sailors are new, they need to learn to tie the right knots so that the sail will not be flapping around, will be doing its job. So therefore, learning the ropes, well, yes, an investor who wants to manage his own money in stocks needs to learn the ropes. It's almost like learning how to swim. When you swim, you jump into the water and you have to start propelling yourself in the water, otherwise you start sinking and drowning. So it's like being in the stock market. Yes, it's risky, but if you know how to do it, then it's a little less risky. You can manage the risk. How do you manage the risk after jumping into the pool? Start propelling yourself forward and breathe in and breathe out. So that's why I think there are 3 things that parents teach their children, which are relatively risky, but parents teach your children how to cross the street, number 1. And then, because it's important to learn how to cross the street safely and successfully. And then parents send their children to summer school, learn how to swim, because it's important to be drown-proofed. And number 3, many parents say, okay, go to driving school, learn how to drive a car. Now, it could be life-threatening to be in a car accident, but parents still put their children in driving school because it's an important skill nowadays. Now, there's a 4th skill, which is investing in stocks, which unfortunately the parents are still scratching their heads about. So they just send their children to stock market school.
Or the children send the parents to stock market school.
Or the children pull the parents, come attend the stock market school lecture that I attended so that I can convince you to let me manage a fund, let me run 100,000 pesos or or maybe a more significant portion of the family savings, and I promise I'll do my best.
And you've been doing your best since with the First Metro Securities since 2009?
Yes, I've been doing my best at market education to explain the pros and cons to the investors, and to say that it is risky, but if you just do research, if you're careful, you monitor the situation, and you invest long term, you could get very good results. It's like if you drive a car carefully, you can get from here to Baguio in a short number of hours. If you can, it's safer to walk, but it's such a long distance, and that it's you know, some speed is okay as long as you know what you're doing. So it's just, stocks is a matter of your money running, shall we say, running at a faster pace than just sitting down in a savings deposit, or walking slowly in a government bond at the rate of 3% a year or 5% a year.
Okay, Sandy, and so finally, over the years, the interest rates that a lot of institutions have been paying out to investors has gone down quite significantly. So all the more reason to learn about stock market investment to balance the low rates that you get.
Yes.
Is that fair?
That's fair, because if savings deposit rates are below 1% and time deposit rates are 1.5 or so, and inflation is at 2 or 1.9, then you have to do something to make a portion of your money grow. If all you want is to preserve capital, then if you have 100 pesos, why not put 10% of it in stocks? Or why not put 30% of it in bonds? You can't keep everything in cash because it's the lowest growing asset. So therefore, just to preserve against inflation, you'll need to put 10% in stocks or 30% in bonds. Now, if you have the ambition to let your money grow, say 15% a year, then it'll have to be 90 or 100% in shares of stock, because bonds can't grow 10-15% a year, not unless you're an expert bond trader. So I would recommend that people who have the ambition to let their savings grow, because they have a target, an objective, to put some money in stocks, in good stocks, in well-chosen, fundamentally sound stocks, and let the economy do its work and push up incomes and savings, and all of that consumer spending is going to push up the profits of the listed companies who provide food and related services and products. And then the investor in the listed companies will get his returns through cash dividends and higher share prices.
So as a sort of summary, then everybody should learn to cross the road, get in their motor car, go to the beach, have a swim, and then go to a stock training program.
Yes, that would be perhaps the fourth skill that parents should be teaching their children, but they themselves are new to the art and science of investing in shares of stock. It's a brave new world.
Well, thank you very much for that enlightening information, and I hope and I'm sure that a lot of the listeners will have gained a lot of knowledge, and will be looking to cross the road, get in their car, go for a swim, and come for some training.
Yes.
Thank you very much indeed.
Thank you too. You're welcome. Good day.